Hello, I'm Jackie Hewitt, Vice President of Membership Engagement for the Raleigh Chamber. Thank you for joining us. In today's webinar, we will highlight the top priorities for businesses as they make decisions during this pandemic. We will also address issues related to employment law and accounting. You will hear from Marshall Stein, Raleigh Office Lead at Elliot Davis, and Kevin Siglowski, Partner at Poyner Spruill. You may submit questions at any time during the webinar to the question box in your control panel. I will now turn the program over to Kevin.
Good afternoon. Hopefully everyone can see my screen here. I'll pull up my PowerPoint slides. As Jackie said, we're splitting this into legal and accounting. There's a lot of crossover areas. I'm going to primarily focus on a few things. One, the new sick pay and family pay and leave requirements under the Families First Act. Then we're going to talk about the state of unemployment, both North Carolina and the federal supplements, which are in three parts. Talk a little bit about employee benefits issues and some discussion about layoffs and furloughs. First up, the Families First Act. This was quickly passed by Congress in mid-March and signed by the President. Does a few things. First thing to know is the effective date of this was April 1st, 2020. I saw some preloaded questions, and I've heard similar questions from clients and others about what it means if you provided this leave voluntarily or something that looked like this leave before April 1st. The answer to that is it doesn't mean anything. You don't get credit for anything you already did. So with the exception of FMLA leave, which we'll talk about, the 2 weeks of sick leave that are required under this act has to be granted if the employee qualifies as of April 1st or sometime thereafter. You don't get retroactive credit. Who does this cover? All employers with fewer than 500 employees are subject to this. So that's the baseline. If you have fewer than 50 employees, you may be, but are not necessarily exempted. We'll talk a little bit about what that means. There's a required Department of Labor, U.S. Department of Labor poster that they've come out with. Every employer under 500 has to put up that poster. Probably raises an immediate question in some folks' minds about, all right, all of our people are working remotely now. How do we put up the poster? Does it matter if we put up the poster? I will point you to some guidance that explains that, but the short answer is you need to get it to your employees. So if everyone's working remotely, you need to send that out probably by email to get it in everyone's hands. So the Families First Act requires paid leave under 6 different circumstances. And I'll confess that these slides are wordier than I would typically prefer, but for sake of doing this as a webinar and making sure you have all the relevant info, I ripped this straight from the Department of Labor's guidance, their publication. So under the Families First Act, and that's, as you see throughout the presentation, the FFCRA is the Families First Act. An employee gets up to 2 weeks of sick time for any of these 6 reasons. So the first 3 involve the employee being either quarantined or sick. The fourth one is the employee taking care of somebody else who is quarantined or sick. The fifth one is providing child care. And for purposes of now, we can ignore reason 6, which is any other substantially similar condition designated by the Department of Health and Human Services. That has not happened yet. So for right now, ignore number 6. The simplest way to sort of refer to this, and I'll slide back to this slide as we go through it, is to refer to the reasons, the numbered reasons, because that's how the DOL has listed out their guidance on what you get as an employee in terms of pay and duration. So what are the reasons that you are required to give your employees leave, paid leave under this? The first one is the employee is subject to a government quarantine or isolation order. Second reason is the employee has been told by a healthcare provider to self-quarantine. And back up a step, you'll see this in the definition. This is all related to COVID-19. So to get any of these leaves, the reason the employee is sick or caring for someone else or caring for a child has to be caused by or related to COVID-19. Third one is the employee has symptoms and is seeking but has not yet received a medical diagnosis. The fourth one is to care for somebody else who's quarantined either by the government or healthcare provider. And then the fifth one is to provide care for a child whose school or daycare or general child care, whether that's a nanny or a grandparent or next door neighbor, is no longer able to provide that care because of COVID-19. So those are the reasons that people can get leave under this act. Talk about how much they get in terms of time and how much they get in terms of money. So for the sick leave, this is up to 2 weeks, and that's defined as 80 hours. So a full-time employee who is scheduled to work 40 or more hours can take up to 80 hours of this job-protected paid sick leave. If the employee typically works more than 40 hours a week, he or she can't get more than 80 hours. How that would work in practice is, say I work 50 hours every week and I need this sick leave under this Families First Act. In the first week, I'm sick, subject to a quarantine order, for instance, and I can't come to work at all. I can take 50 paid hours. The second week, even though my normal work week is 50 hours, I can only take 30 paid sick leave hours because the 50 plus the 30 equals the 80. So it's not 2 calendar weeks, it's 80 total hours. For part-time employees, you look at what their schedule is. If you have an employee who over the last 6 months has averaged 30 hours per week, that employee can take up to 60 hours of this sick leave. That's how much they get paid. So the first thing to know is you cannot require your employees to use any other paid leave in place of this. In other words, if they qualify for this leave, you can't say, well, you're not allowed to take advantage of that until you've burned up your PTO or you've used all your other sick days. This is an add-on to any policies you currently have in place. How much do they get paid? They get their full regular rate up to a cap, and that cap is $511 per day. So if an employee makes $300 a day, they get $300 a day while on this leave. If they make $600 a day, they get $511 a day while on this leave. That is for any of the first 3 reasons, which are, again, the person's been quarantined or isolated either by the government or a doctor, or they personally are experiencing COVID-19 symptoms. So for any of those reasons, they can take up to 2 weeks off at full pay, up to $511 a day. For employees who are taking the sick leave for any of the other reasons on that list, which are caring for another person who is subject to quarantine or isolation, or for the child care, they get up to 2/3 of their normal pay, which is capped at $200 a day. So the dollar amount that the employee gets is determined by the reason they are taking this sick leave. And for all of these purposes, this is, again, maxed out at 2 weeks or 80 hours. One thing to note about this sick leave that's up to 80 hours of sick leave, there is no time and service requirement. So if your company hired somebody the 2nd or 3rd week of March, they are eligible for the full amount of this sick leave as of April 1st. They don't have to have been with you for any particular period of time or any time at all. That answer is different for the child care leave, and we'll talk about that in a second. So in addition to the 2 weeks of paid sick leave, the Families First Act expanded the FMLA, which is the Family Medical Leave Act. And they did this, and this will be important in a minute, not by writing a new law, but actually by amending the current FMLA. So under this Emergency Family Medical Leave Act, employees who cannot work or telework because they have to care for their children, which is defined as somebody under the age of 18, because the school closed or the daycare closed, or again, a nanny, a family member who typically cared for them, whatever the child care arrangement was before, if that child care arrangement is unavailable because of COVID-19, the employee can take up to 12 weeks of leave. So that's the 2 weeks of paid sick leave before plus 10 more for a total of 12. And again, this is paid at 2/3 of the person's daily pay, up to $200 a day, maxed out at $200 per day. Back up a second. The reason it's important that they modified the FMLA instead of just writing a new law is that if an employee has used any or all of their 12 weeks per year of FMLA allotment for any other purpose, that counts against the 12 weeks that are now available for this emergency leave, and vice versa. So if an employee uses, for instance, 6 weeks of this emergency leave for childcare purposes, childcare is restored because stay-at-home orders are lifted and lockdowns are lifted, the employee comes back to work and then in 6 months has a serious health condition and needs FMLA, that employee will only have 6 weeks of FMLA left. So the 12 weeks of FMLA coordinates and runs concurrently with this childcare add-on for FMLA purposes. All right, so we've explained what employees are entitled to under these leaves and how much they get paid. You as an employer may be thinking, well, this is great. We're in this dire economic circumstance, and now the federal government is telling me I have to provide paid leave where I did not have to pay for that before. The upside of all of this is there is a dollar for dollar tax credit for the amounts of leave that are provided. Marshall and his folks will talk more about the tax details of the various laws that have been passed, but for employment purposes, it's important to note that up to those caps, the $511 a day or the $200 per day, employers get a tax credit on the FICA taxes they would otherwise have to submit to the federal government with their 941 forms. So what you would do as an employer is you keep track of the amount of leave employees take, keep track of how much you pay them for that, you keep track of any costs associated with maintaining their employer-provided healthcare coverage while they're on the leave. You add up all those amounts and you get a tax credit for that when you do your payroll tax submission to the federal government. I said earlier on that if you provided leave to an employee for some reason before April 1st, you don't get credit for it as to the 2 weeks that you must provide, which is true. In addition, you don't get to take the tax credit on any amounts you voluntarily paid before April 1st. So for all of these purposes, the April 1st is the trigger date, and anything that happened before that doesn't matter for purposes of this leave or the tax credit associated with it. I have had some clients who have asked about and have gone ahead with doing additional pay beyond the caps. The $511 a day is going to cover most employees. The $200 a day obviously going to cover fewer. I have some clients who have decided to pay more than the $200 a day. Some are paying full wages, some are doing other amounts. The important thing to note is you are free to pay more than $200 a day for those reasons 4 through 6. Again, if we look at 4 through 6, which for right now is reasons 4 and 5, caring for somebody else under isolation or quarantine or providing childcare, you're free to pay more than $200 per day. However, you can't take the tax credit for more than the $200. So the rest of it is coming out of your pocket without effectively a reimbursement from the federal government. One final thought on the family medical leave portion of this. So I said earlier that the sick leave, the 2 weeks of paid sick leave that employees can take, there is no time and service requirement. That is not true for the child care portion. So for reason number 5, which is taking up to 12 weeks to provide care for a child who's lost a child care arrangement, an employee must have worked with the employer for at least 30 days before the leave is taken. If not, they are not eligible for this leave. It's effective April 1st. It is all of these leave requirements as of right now will expire December 31st, 2020. So the window you're looking at for when you have to provide this is April 1st to December 31st this year. Strongly recommend that you put up the poster, which we're going to talk about in a minute, which is required by law. I also recommend you go in and modify your current sick leave or PTO policies and modify your current FMLA policies to incorporate the requirements of this new law and publish those policies back out to your employees. So at the beginning, there's a required poster, as there is for most things government. Hopefully these slides have gone out. I think Jackie said that there's handouts, electronic handouts that you all have access to. So you can just click this hyperlink. If you haven't gotten the poster yet, there it is. On the DLL website, there's also an FAQ, but the short answer is post it at the physical location if anyone is working at the physical location or whenever it reopens. In the meantime, email this to all employees. You're not required to provide it to applicants. If you have any applicants right now, just to current employees. Briefly on the exemption, and this is probably beyond the scope of what I have time to cover in my allotted time here. The Department of Labor has a lengthy frequently asked questions page about all issues associated with this Families First Act. In that section of the FAQ, there's a discussion about if you have fewer than 50 employees, what that means in terms of whether you're exempt. And there's 3 ways you can be exempt, but the long and the short of it is providing the paid leave would have to endanger the ongoing viability of the operation. So, for instance, one of the examples is providing these paid leave benefits will cause the company to expend more money and expenses than it takes in revenue. So if you could provide that evidence to the government, you could potentially not provide this leave. It's probably a more fact-specific question than a bright line rule at this point. But just know if you're an organization with fewer than 50 employees, you should investigate whether you're exempt from having to provide this leave. The other possibility for being exempt is healthcare providers, which the Department of Labor has now defined very broadly. Direct care healthcare providers are not entitled to these leaves under the Families First Act. Nursing homes, assisted living facilities, home healthcare organizations, doctors' offices, hospitals, medical testing labs. There's other things on the list, but those are examples of what the DOL said are healthcare providers that do not have to allow this leave, presumably because those are the parts of the economy or parts of society we most need operational right now. And if every employee who had children home from school left the doctor's office, there wouldn't be anyone to run the doctor's office, which is counter to what we need. So the Department of Labor did wisely expand what healthcare provider means. If you are a healthcare provider and you haven't already figured out whether or not you're exempt, you should certainly look into that in terms of whether or not you have to provide this leave to folks. Unemployment, this is the other, from an employment law side, big area that we're getting a lot of questions about. So North Carolina unemployment, anyone who's terminated, laid off, or furloughed might qualify for benefits. There's a federal supplement, which we'll talk about. In some circumstances, you could still have somebody on your payroll whose hours or pay rate or both who have been cut, and that person could qualify for benefits. There's an executive order signed by Governor Cooper a few weeks ago that did several things, the most important of which, if you're an employer, said that if you have to lay people off or cut their hours or cut their pay because of COVID-19 and they receive unemployment, those benefits will not be charged against the employer, will not increase the employer's unemployment tax. So it switches, in my mind, the incentive structure, which is if you're an employer and you've had to cut people back, other than, a lot of times employers hope people don't go apply for unemployment. They fight unemployment claims in an effort to hold down their tax rate. If you're an employer right now, there's no incentive to do that. And in fact, perhaps some incentive to encourage people to go apply for unemployment and to point them in that direction if they are partially unemployed in an effort to help them out financially, take care of them, and frankly, help morale and hopefully keep them wedded to your organization as we come out of this. So North Carolina unemployment, this for right now, we're totally ignoring the federal rule or the federal supplement. So North Carolina's maximum benefit per week is $350. If you are totally unemployed, that is the most you can get. Some people will get less depending on their earnings. The way the law is written is the max duration of unemployment is between 12 and 20 weeks, depending on the current unemployment rate. That is set at 12 right now. I don't know when they are going to reset that. As of the end of February, the unemployment rate was 3.6%. The duration stays at 12 weeks, up to 5.5% unemployment. I would expect we're going to exceed that at some point, but for right now, your operating premise should be 12 weeks at $350. It's the most anyone can get. And I've highlighted here the hyperlink. The other thing Governor Cooper's order did was encourage people to apply online. This is the link. Sometimes the application online works, sometimes it doesn't, sometimes the website crashes. I know there's a lot of frustration. The only thing I can say is calling the phone number is worse. So just going to have to encourage your employees to stay on it with the website. I believe it is mostly functional. We're in better shape than some states, but that's the hyperlink to apply. Also, if you go to the DES website, they have some good primers available for employers and employees on how the federal supplement works with the North Carolina rule. So we talked about this Governor Cooper's order. The final thing here, the last main bullet point, Governor Cooper instructed the Division of Employment Security, which is part of the Department of Commerce, to be flexible about things that are typically barriers to receiving unemployment. So right now, the biggest difference is typically if you're on unemployment, you have to look for work and prove to the Division of Employment Security that you're trying. If you lose your job for COVID-19 reasons, the work search requirement is suspended right now. So you will receive unemployment even if you're not out looking for jobs. If you lost your job because of COVID-19, you don't have to provide any evidence to DES that you're searching. For those of you who have not let people go or have some people you haven't let go, but you've had to cut them back, two things to know. One, these numbers are correct. Why none of these match up is a question for another day, but employees can quit. So typically the baseline rule is if you quit your job, you don't get unemployment. There are exceptions to that. One of them is if your employer cuts your pay by 15% or more, or cuts your hours by 50% or more, you can quit your job, prove to DES that's why you quit, and they will give you full unemployment. Perhaps more interesting right now, if you're on the employer side, is if you reduce somebody's schedule by 60% or more, they can apply for unemployment and receive partial unemployment benefits to bring them back up close to or up to what they were making when you had them fully employed. So that's an important thing to know as an employer. Federal supplement. So there are three pieces to this. The states are waiting on guidance from the federal government about how to implement these. With all the stuff I've talked about and that the Elliot Davis hosts are going to talk about, it's changing rapidly. The government agencies had Congress dump this stuff on them and are flying around trying to come up with guidance, regulations, those sorts of things. So the states are waiting for the feds to tell them how to administer this. But there's three pieces. The first is, and the main one right now, the federal pandemic unemployment compensation supplement provides an extra $600 per week to any person who is eligible for unemployment under state law. One of the interesting things about this is it is not prorated. There's no sliding scale. So if you get $350 per week from North Carolina, you get $600 from the feds. If you get $20 a week from North Carolina, you get $600 from the feds. That $600 is a flat rate regardless of what your state amount is, as long as you're eligible under state law. That $600 stays in place through July 31st. The second one here, the abbreviated PUA, North Carolina has made no progress on rolling this out yet. This is excuse me, that's not true. They have not provided a ton of guidance yet. They've pushed this out to April 25th in terms of when they think they're going to be ready. This is the portion that if you're a gig worker, an independent contractor, somebody who didn't have W-2 earnings, who didn't work for an employer that was paying unemployment tax, the federal government is now going to provide you unemployment in the same way that you would have been eligible from a state if you had been a W-2 employee whose employer was paying payroll taxes to the unemployment agency. The third one, the unemployment compensation add-on, this provides up to 13 additional weeks of benefits beyond state law. So North Carolina, again, I said, the maximum you can get in North Carolina right now is 12 weeks. So two things are going to happen. One, the max under North Carolina dollar-wise is going from $300 to $950. Two, because of this third bullet point, the max duration is going from 12 weeks to 25 weeks. If that 12 weeks increases with the unemployment rate, the 13 additional weeks from the Fed will just get added on to what the then current North Carolina maximum is. Few points on employee benefits. And I've gotten a lot of questions from clients about, should I lay off employees? Should I furlough employees? In some of those cases, I'm not sure that folks really understood what the difference between those two terms were. one positive thing that has happened is certain, perhaps all that operate in North Carolina, but certain ones for sure of health insurance providers have published guidance that said if you furlough employees, they can stay on the group health plan for X period of time. So if you furlough somebody, meaning you continue to identify them as an employee, but they're getting no hours and no pay for some period of time, that typically a furlough has some defined time period, 2 weeks, 2 months, where you keep somebody attached to your organization, call them an employee, but they're not working and you're not paying them. So to healthcare providers, and you need to check the terms of your particular provider's guidance, but they're allowing employers to keep employees on the health plans while furloughed, which is, of course, good for the employees. Separately from that, whenever those deadlines expire, if it's the end of April, the end of May, if those health plans don't allow you to keep furloughed employees on beyond that, you've got to go look at the terms of your health plan. Typically, the health plan, in all cases, will say how long you can leave somebody on the plan after they no longer work for you, whether that's the end of the then current calendar month or 30 days or 60 days. At some point, they're no longer eligible for the plan. The other thing to keep an eye on once these exceptions that healthcare providers, health insurance companies rather, are making for furloughed employees is the plans typically have a minimum amount of work requirement, such as the worker has to work at least 30 hours per week to qualify for benefits. Otherwise, they lose eligibility. So those are the two main provisions that you need to go look at for furloughed employees once you hit the end of whenever your health insurance company says they're going to allow you to keep furloughed employees on your plan. Some other things, so the Elliot Davis folks are going to talk more about the CARES Act and some stuff that's in there. I have, I think, one slide on this about the 401k and other retirement plans. One way that Congress has tried to allow employees to get at money that would otherwise be difficult to access or impossible to access because of terms of retirement plans is to allow 401k, 403b, or 457b plan distributions up to $100,000 during 2020 to someone whose spouse is diagnosed with COVID-19 or who has adverse financial consequences because they've been quarantined, furloughed, laid off, or had their hours reduced, or been unable to work because of childcare reasons, any of that because of COVID-19. The exception eliminates the 10% early withdrawal penalty that would typically apply to a hardship withdrawal from a 401k plan or other retirement plan. And the CARES Act also allows employees who take these hardship distributions to spread the taxable income over a 3-year period. Separate from the distribution, plans may be amended if the employer wants. They don't have to do this, but they may be amended to allow participants to take loans for similar reasons up to $100,000 or 100% of the vested account balance. So I'm going to leave the rest of that for the Elliot Davis folks. I've gotten dangerously close to tax on this slide as it is. So we'll leave the rest of that for them, but those are important things to know from an employee benefit standpoint in terms of tools that are available to your employees if they're suffering any type of adverse financial consequence caused by COVID. Layoffs and furloughs. So again, furlough typically leaves somebody connected to the employer, listed as an employee. Traditionally, it's been for a defined time period, or at least an estimated time period with some parameters around it. And the employee does no work, receives no pay, and then at the end of that time period is brought back online, their hours and pay are restored. A layoff is typically indefinite. So sometimes those terms get used interchangeably. That is the traditional meaning of those. Why does this matter? Well, for the reasons we discussed before, if you furlough employees rather than laying them off, it is possible, if not likely, that there will be some, at a minimum, health insurance benefits for those employees. Once the health insurance coverage ends, as an employer, you're required to send a COBRA notification to the employees. It's important to understand when that notification requirement arises, which is when they are no longer no longer eligible to participate in the plan. So in this furlough situation, for instance, if your health insurance company says you can leave furloughed employees on the plan through, for example, the last day of May, if you have furloughed employees on the last day of May who are then ineligible, that would be the trigger date. The last day of May would be the date that would trigger your COBRA requirement. It's going to be very fact specific. I have this in here to remind you all to not forget to do this and to talk to your employee benefits attorneys, your insurance brokers, study your plan documents, and make sure you understand what's going on here, because there are significant financial penalties if you don't fulfill the COBRA requirements. The other reason that furlough and layoff are important, employees that you may have on visas, H-1B or E-3 visas, cannot be furloughed because of the prevailing wage requirements. So those employees, in order to still be listed as employees with you, must receive their regular pay. Final thing from me before I kick it over to Marshall and his team, the WARN Act, I got a lot of questions early on about this. So for those who don't know what this is a federal law that requires you to provide a minimum of 60 days notice to all employees in the event of certain types of layoffs that are shorthand referred to as plant shutdowns, plant closings, or mass layoffs. You see here what the definition of a mass layoff is. In order for this act to apply, you have to have at least 100 employees and you have to lay off at least 50 of them. There are other more detailed requirements, but that's a bare minimum. The WARN Act probably is not covering any COVID-related layoffs that have happened so far, for one primary reason, which is there is an exception. There are three exceptions. The one that's applicable is an unforeseeable business circumstance. I think it is a fairly strong argument that if a pandemic strikes and the government, with days or at most weeks of notice, decides to close your business, that was an unforeseeable business circumstance. If that happens, you're going to be excused from the requirements of the WARN Act. The other thing, for those of you who are familiar with this or should be and are interested in how to minimize your exposure, layoffs of less than 6 months don't trigger WARN. So what I've been telling clients is, if you've got to lay people off and you have any optimism or ability to realistically think that you're going to bring these folks back once the lockdown orders are lifted, and you think that could reasonably be within 6 months, when you provide them notice of the layoff, tell them it's for an indefinite period, but you expect it to be less than 6 months and that they'll be returned, but that's subject to change. You'll notify them. I think that document helps you on the front end have a good faith argument that you don't have to meet the WARN Act notice requirements. If that doesn't work, you could fall back on the unforeseeable business circumstance exception. So those are my slides, which I've flown through. I'm going to turn it over now, or have Jackie turn it over to the Elliot Davis folks, and then we're going to do some combined Q&A at the end.
Okay, well, good afternoon, everybody. Thank you, Kevin, for that, for going through all that information in such good detail. As you can obviously tell, a lot of information, a lot of moving parts to this. And so again, my name is Marshall Stein. I'm a principal and the office leader here with Elliot Davis in Raleigh. First things first, hats off to the chamber, hats off to Jackie and the folks at the chamber for putting this together for the members and for the constituents here in Raleigh. As you no doubt have already gotten a sense, there's a lot of intricacies and really just a lot of complexities to a lot of this information. And so the purpose of the next few minutes with us going through some information is to go over some accounting and tax issues. And JJ, Rebecca, just can you see the screen, the slide deck? Okay, good. Just checking. I want to make sure we're not starting off with any technical difficulties. So before I start, I want to introduce Rebecca Leishman, who's a tax senior manager. Rebecca sits in our Greenville, South Carolina office. And then the local celebrity, JJ Littrell. Some of you may recognize JJ. JJ is a director in our consulting group She sits in our Charlotte office, but had the opportunity to join Deborah Morgan on WRAL about a week or so ago. So JJ and Rebecca, thank you for being here.
Thank you.
I'm going to start by just talking about a few implications of the two SBA business financing provisions that have been unveiled, that a lot of our clients and a lot of the folks in the community are taking advantage of, and then we'll move into the latter half of the presentation to talk about tax implications and just general consulting and best practices that we're seeing and that we're recommending with a lot of our clients going into such, truly unprecedented times. So again, thank you for being here, and looking forward to Q&A at the end of the presentation. So first things first, the first section I'm going to touch on are what are called economic impact disaster loans under the SBA or EDLs. There's two types again that we're going to talk about, the EDLs and the paycheck protection loans. I'm going to spend less time talking about the EDLs and move into the PPP, because as I think you'll find, those are the more maybe perhaps appealing and popular, definitely, at least from the folks that we've talked to. With the EDLs, it's important to understand that businesses and most nonprofits with less than 500 employees, or those that meet the SBA size standards, and I'll talk about those shortly, they qualify for these. And there are some special accommodations for the hospitality and dining industry. The SBA has what's called common control rules and association rules that rule out a lot of companies that, such as private equity owned or venture capital controlled, that would disqualify due to their association relationships. Those in the hospitality industry have largely been scoped out of that, and as have franchises. And the purpose of that was to try and stabilize restaurants, hotels, things like that. And so if you have an NAICS code of 70 that begins with 72, that applies to you. You're in that group of companies that would be scoped out. There is a link here to the SBA size standards, and I'll see if I can flip to those real quick. Yeah, and so these are the same size standards that the SBA uses for really all of its loans. But again, it's important to recognize that you only have to qualify that, or to have less than 500 employees. The EDLs loan amounts are up to $2 million with discretion to exceed, and up to 25,000 of those, or amounts up to 25,000, can be unsecured. The EDLs have an interesting provision in them, in that they have emergency advances up to $10,000 within 3 days of application. So you submit an application directly with SBA. This is different than the PPP, which we'll talk about. The EDL application is directly with SBA, and within 3 days of the application, you have the option to receive a $10,000 emergency advance. That we've learned in recent days that that's being limited to $1,000 per employee. So if you're a small company with, say, 5 employees, that would be limited to $5,000, but up to $10,000. And the nice thing about, if there is such a nice thing about these, is that if the application is denied for one reason or another, that $10,000 is effectively non-refundable. It's an emergency advance that you can just leave with. And these are designed to cover payroll, fixed debts, accounts payable, and other expenses that could have been paid should the disaster not have occurred. The loan proceeds need to be used during 2020. And the big differentiator between the EDLs and the PPP is that for the EDLs, there's no whole or partial loan forgiveness options. There's a 1-year payment deferral. There is a collateral requirement on the EDLs. There's for those that are less than $200,000, there's no personal guarantee requirements. The rate's a little higher than the PPP. You've got 3.75% here for businesses versus 275 basis points for nonprofits, with a maximum term of 30 years. And again, you have the option with the EDLs to apply directly with the SBA, and we've got a link here for those, and we'll make these slides available. I think that I've got it up on the other, here it is right here. So you can actually apply directly on the SBA's website. So it is a quicker, more immediate, but at the same time not as attractive and definitely not as popular option compared to the payroll protection loans. JJ or Rebecca, anything you want to add on the EDLs before I move on to the PPP?
No, Marcia, I think the biggest thing is just what you just said about the $10,000 that was originally $10,000 and now it's $1,000 per employee up to $10,000. So it's just a good reminder. Everything we talk about is subject to change on a daily basis. We're seeing more and more guidance and clarifications and things coming out. So just a good reminder that these things are evolving very, very quickly. And so to definitely make sure you're staying in touch with service providers who are on top of it, because there's a lot to manage with all the changes.
Yeah, thank you. Moving into the payroll protection program. These are similar, but also uniquely different from the EDLs. If similar eligibility requirements, there was actually some concern when the PPP program rolled out. The original understanding of these was that you could be what the SBA calls a small business concern, which is the definition that's on the website. That's by NAICS code or which is generally based on revenues, or you could be or less than 500 employees. There was actually a little bit of a flaw in the original application, is that instead of or, it said and. And so it suggested that you had to be, not only did you have to be a small business concern, you had to have less than 500 employees. And so I do a lot of work in the construction and have a lot of contracting clients. And so you've got, a lot of those companies, just for instance, you qualify from an employee perspective, but their revenues are in excess of for their NAICS code, it's $39.5 million. And so it effectively scoped out, if you read it, technically it scoped out a lot of contractors out of this. SBA has come out since then and clarified that was not the intention. It was just a little bit of a flaw, and it was an and instead of an or. And so to clarify, businesses and most nonprofits with less than 500 employees, or you can have more than 500 employees and still meet the SBA size standards by revenue and qualify for these. And similar to the EIDLs, private equity and venture controlled businesses likely will disqualify due to the affiliate and common control rules. Now, the loan amount here is calculated as 2.5 times or 250% of your average monthly payroll costs, either for the last 12 months or last year. There's some, I think there's some latitude as far as what period you're looking at, but that's gonna be capped at $10 million. Now, individual payroll amounts per person are capped at $100,000 for cash. There's actually, the SBA's clarified that there's no cap on non-cash compensation. That's probably, the exception rather than the norm. But the individual, when determining what the payroll costs are for the last 12 months, those calculations are going to be capped at $100,000 per person. Keep in mind that the definition of payroll amounts is going to include state and federal taxes, benefits, things like that. So be sure to include those amounts in your calculations. And you can see there, yeah, it includes federal and state taxes and benefits. The important thing to remember, though, is that borrowers must certify in good faith that the loan is necessary to support the ongoing operations of the business. And so lenders, the SBA has clarified that lenders have the ability to rely on the certifications of the individuals. They're not necessarily required to validate or to really test those certifications, but it will be an individual certification from the borrower that the loan is necessary to support the ongoing operations. And the loan proceeds must be utilized by June 30th to be eligible for loan forgiveness. Now, I want to talk about loan forgiveness because this is one of the things that makes the PPP so interesting and so appealing. These are eligible for forgiveness. And one of the questions that we get a lot is, what sort of forgiveness is this? Is this taxable income to me, or what? And it's actually non-taxable income. Typically, loan forgiveness would be a taxable event for the company. It would be non-taxable in this case, which is really interesting. Now, it's important to keep in mind, though, that the forgiveness, the purpose, the intent, and the spirit of this is to provide the company with funding to keep folks employed, to keep folks working for a 2.5 month period, through now and the end of June. And so there's a forgiveness, but that forgiveness is potentially reduced by any decreases in headcount and more than a 25% reduction in individual compensation, which is again capped at that $100,000 between 215 and 630. So if there is a significant decrease in headcount between now and then, and if there's a significant reduction in compensation between now and then, the forgiveness could be eliminated or reduced. There's a concept of proportional elimination. So if there is, say, a 50% reduction in headcount, there would be a 50% reduction in the forgiveness of the loan. Similarly, on the compensation side, SBA did allow a 25% buffer. So they said you can reduce compensation by 25% and still qualify for full forgiveness of the PPP, because we acknowledge, the SBA, which I, Marshall, am not part of the SBA, I'm interpreting their words here, that they acknowledge that that they estimate that up to 25% of these loan proceeds might need to be used for things other than payroll and related costs. There's a 6-month payment deferral, but interest still accrues. Interestingly, there's no personal guarantee or collateral requirements. A fixed rate at 1%, which, as you know, in this market is quite low. 2-year terms. And so the question might be, well, gosh, what happens if I take one of these loans? If I apply, I get approved, and as we've all heard over the last few days, there's lots of folks applying. There has not been much in the way of approvals yet. I think the process, the process with the individual banks is just the channel's really stuffed with just a lot of applications right now, and we're waiting for additional guidance from SBA on how these things are going to be practically applied. But worst case scenario, let's say you apply and get approved for a loan and it does not get forgiven. Worst case scenario, it's a loan at 1% over 2 years, which is, in the grand scheme of things, is not that bad of a deal. No prepayment penalties, origination or maintenance fees. And then the one key difference here whereas the application for the EDLs is directly with the SBA, the PPP, that's going to be done through your bank. And so one of the things we're hearing, I'm sure we probably have some bank representatives on the webinar today. One of the things we're hearing from there's a lot of banks in town and throughout our client base that are working very, very quickly to work with as many clients as they can on these. And keep in mind that it has to be an SBA approved financial institution to work with you on one of these payroll protection program loans. And then finally, you can visit the U.S. Treasury site with the link here to get additional information. One of the questions we had received prior to the webinar was what are some links to some external resources. So here's the U.S. Department of Treasury website that has more details on the PPP. In addition to that, Elliot Davis, Poyner Spruill, we both have COVID-19 resource pages that are available for you, and what we can provide references to those as well. Rebecca, JJ, before I pass it back off to you guys for the tax and just general consulting topics, anything you want to add on the PPP?
I think you covered it.
All right, good stuff. With that, I'll turn it over to you guys for income tax considerations.
Great. Thanks, Marshall. So Rebecca and I are going to talk through income tax considerations and then also payroll credits. I know you guys heard a lot earlier about the Families First, the extended FMLA, and the extended sick pay, which are reimbursed through payroll credits. But then also there's some others within the CARES Act, which is where the PPP and the EDL comes from, that Rebecca and I are going to talk through. Marshall, are you able to give me control of clicking, or are you going to be our clicker? Awesome.
I'll just click for you. Just tell me when you need it.
That's perfect. Thank you. So I'm going to talk through some payroll tax provisions. Before I get into that, I just kind of want to lay the foundation for how Rebecca and I are going to approach these topics. Obviously, as you've heard, this is highly technical, a lot of stuff that will put most business owners to sleep. And we appreciate you guys kind of wading through this with us, because it is really important for businesses to understand this. But want to just kind of pull back a little bit to kind of a 30,000-foot view. We're going to be talking about, and you've already heard earlier in this presentation, but really the goals are, how do we keep cash in your business? How do we get cash into your business that isn't there right now? And how do we think about your people and your continuity for the long term? So really thinking about how all of these things interplay together. Again, it can be very complex. As we mentioned before, these things are changing on a daily basis. The clarifications and things and interpretations are coming rapidly, and we expect that there may even be more to come with things that will be rolled out. So we're here to partner with you to work through these things, but also just know that it is a lot of information. We know that. The goal here, though, big picture, take care of your people, have a business that has a plan for long-term continuity, not just head down, focus on these couple of weeks and then look up and wonder how the business will continue, but long-term continuity for your business, protection for your people, making sure that they're getting paid, and then keeping cash in the business or bringing cash into the business. So that'll be kind of the approach that Rebecca and I take for the next couple of slides. Big picture, there are two other, I didn't get into the Families First Act because that was covered so well in the beginning, but those credits are also applied through payroll tax credits. Just really quick, for all of the credits from the CARES Act and from Families First that are related to payroll, you are able to get dollar for dollar. You could reduce your remittance of your payroll taxes related to those credits that you're due. If you end up with credits that exceed your payroll tax liability, your employer's payroll tax liability, you are able to file a form to have refunds expedited. So the form is 7,200, and if you file that form, then you are able to get that expedited refund. You do not have to wait until your quarterly 941 filings to get that refund back. So quickly, I'll go through these two items and then pass it over to Rebecca to talk about the plethora of income tax issues that we have here, but just some payroll tax provisions to be aware of. The employee retention credit. So this is a credit that you all may have heard of, and I will pause for a moment here and mention that you're going to hear a lot of different requirements. There's a lot of different eligibility stipulations. There's a lot of different definitions of what business sizes are, what affiliate rules are in play. So a lot of times we're hearing questions where people are hearing pieces of something from CARES Act and they're marrying it to something they heard from Families First. I often tease that it's very clear people went into separate rooms to write these things and they came back together and put it in a document and got it out. I think we all appreciate the speed in which these things were brought to us, but I think in some of that there's a little bit of clunkiness here, so it can be very confusing of what applies where. So we try to kind of lay that out for you here. As far as the employee retention credit. So this is for eligible employers to be able to receive a credit of up to 50% of qualifying wages that are paid after March 21st. You'll note that these dates are different throughout too, and that's not a typo. That is real. So March 21st for a maximum credit of up to $5,000. So you'll also see a reference to $10,000 in wages, which can be confusing because some people are thinking the credit is up to $10,000. The credit is maxed out at $5,000, which is the 50% of the $10,000 in qualified wages. In order to be a qualified employer, you must either have a business that is fully or partially suspended by a government order due specifically to COVID-19, or have gross receipts that are 50% or less than the same quarter of 2019. So if one of those two things is true for you, then you could qualify for this credit. If you are an employer with less than 100 employees, again, the designation for employee count is not necessarily the same as the Families First designation for employee count. It's important to note that those may be different. If you have less than 100 employees, then that credit is eligible on wages paid, and that is whether or not employees are performing work. So under 100 employees, if you're having employees work or not, they can be eligible for this credit. For employers who have more than 100 employees, this is only a credit for wages paid to employees who are not able to work. So these employees are not working, they cannot be working in order to get this credit. So you are paying wages to folks who are not working, and that's a big differentiator between Families First and if you are under 100 employees for this employee retention credit. And then the other payroll item is the deferral of employer Social Security tax. So this is an interesting provision in that there is not any need to show that you have had any kind of economic injury related to COVID-19 for your business. You may be ramping up business. You could be one of these businesses that is essential and that is actually hiring or doing more business now than before, and still potentially be eligible for this opportunity to defer employer Social Security taxes. There is also not any kind of size indication of number of employees, revenue, anything like that. So this is probably the most broadly available payroll tax item that we've seen. And this is for wages paid from March 27th, not to be confused with March 21st from the Employee Retention Credit. So March 27th through December 31st of this year. Those deferrals are due 50% in December of 2021 and the other 50% December of 2022. So we're thinking of this really like an interest-free loan opportunity to keep cash in your business and allow you to use that cash for other operating expenses currently, and then pay essentially back interest-free loan, pay those liabilities back. Really important on all of these items, the Families First, and the potential for getting your PPP forgiven. Very important that you're keeping really, really good records, that you set up systems and processes to track these things. There's going to be hopefully more information about what the expectation is around the documentation. But for now, our biggest recommendation is to make sure you are tracking very clearly which of these wages apply for which of these credits. Certainly, lean on your service organizations and your partners in your accounting and finance teams, or partners like Elliot Davis to help you with these credits and how they interplay together and how to track them to make sure that you have the opportunity to take advantage of as many of these credits as possible. So that is it for payroll. I'm going to pass it over to Rebecca to talk about the income tax provisions.
Yeah, thanks, JJ. Appreciate it, and appreciate the framework that you've laid for us to have this discussion today. JJ, you talked a little bit about retaining employees and continuing to pay payroll, and there are certainly some benefits that companies can avail themselves to for doing so, but some companies we're finding have made this strategic decision or are starting to evaluate potential layoffs or furloughs, and certainly that's not a decision to be taken lightly. And in many cases, these are employees that have worked with companies for a prolonged period of time, and we're getting the question out of sensitivity to that working relationship and genuine concern for those employees about if I have to lay off my employees or furlough my employees, what opportunities are there, what benefits are there to help them in this time personally. And so a lot of questions that we're getting really relate to some personal provisions that these employers that are exploring layoffs or exploring furloughs can help to communicate to their employees. And we've talked a little bit about them. One of the big ones I'll speak to specifically is the recovery rebate provision that came about in the CARES Act. What that does is it offers eligible individuals up to $1,200 of essentially a rebate, a cash payment, plus $500 per qualifying child this year, 2020. It's based off of your most recently filed tax returns because there are some phase outs for taxpayers with certain adjusted gross income thresholds. So it's based on whatever return is most recently filed. And the good news is that there's an intention for the government to act very quickly on these disbursements. We're told the primary and preferred mechanism for distribution is a direct deposit. And so if there's a direct deposit information on account, then the government intends to use that to disperse those funds. We're told there's going to be a portal set up here very soon so that taxpayers can confirm that direct deposit information. But it is a nice compensation to consider that if there is a layoff or a furlough, at least there is a potential cash inflow that's coming into play to subsidize some of that, reduced payroll benefit. We talked a little bit earlier, and I won't go into detail because I want to make sure we get enough time for questions, but we also talked about the early withdrawal penalty removal on qualified retirement accounts. So you no longer are subject to that 10% penalty for an early distribution. You can do that without incurring a penalty if you're using it to support the spinoff of COVID-19. And as well, you get that 3-year spread on repaying the associated tax due with that. And then of course, the increased unemployment benefits. We talked a little bit that payment has been increased now atop of the state benefits by an additional $600 per week. So certainly some beneficial provisions that the CARES Act brought about to, help employees during this, to help individuals during this, very interesting time we're facing. Marcia, let's forward a little bit to some business provisions. So one thing, that JJ mentioned was, how can we find sources of cash that we don't actually have on hand? And one great thing that the CARES Act has done is actually created an avenue to claim refunds for taxes that you may have paid in a prior year, which again serves as a new source of cash. And one of the primary and most popular mechanisms that the CARES Act now offers relates to net operating losses. And I'll pause here and maybe give a brief history. Net operating losses used to be subject to a 2-year carryback or 20-year carry forward period. And then when we had tax reform back of 2017, the Tax Cuts and Jobs Act actually gave an indefinite carry forward period for net operating losses, but also removed the ability to carry back losses to those prior 2 years. And so you were stuck only looking to prospective income as a source to offset net operating losses. Well, what the CARES Act has actually done is now gone and said any of those net operating losses that were generated post-tax reform are now eligible for a 5-year carryback period. And so, for example, for net operating losses that may have generated in 2018, you can actually look all the way back to your 2013 tax year and forward to see if there's any ability to reclaim those taxes paid. Obviously, there's an anticipation that probably some companies will be throwing off losses in 2020 as they, hit the burden of COVID-19 and its economic impact. So certainly, if you've incurred losses 2018 or 2019, you can carry those back. And then obviously looking forward to however the 2020 tax year shapes out, then there will be a future ability to carry those losses back as well. Another mechanism that we're seeing an ability to reclaim taxes relates to qualified improvement property. This is actually an unintended technical error with tax reform back in 2017 that basically precluded taxpayers from claiming accelerated bonus depreciation on what's called qualified improvement property. And we've been hotly awaiting technical resolution for this issue. And finally, we got it within the CARES Act. So if you are a taxpayer who placed qualified improvement property in service after tax reform took effect, then you are going to be afforded a mechanism to reclaim that accelerated depreciation, which in turn will likely create a refund situation for you, and in some respects may actually add to or create a net operating loss. So subject to the net operating loss rules that we talked about. And as you can see, everything's very interrelated. And so, modeling of all of these provisions is really critical to ensuring you understand what are the benefits you're able to achieve as a result of the CARES Act. The last source of cash that we're finding companies able to access now as a result of the CARES Act has to do with corporate AMT credits. Tax reform repealed corporate AMT, not for individuals, but for corporations. And so any corporations, as a result of tax reform, were provided a path to refund those AMT credits. What the CARES Act done is actually accelerated that process. And so any outstanding non-refunded AMT credits are now immediately eligible for refundability. Marcia, you want to flip the slide for me? There are also additional business provisions that may not in and of themselves create refund opportunities, but they could certainly impact the tax profiles for 2019 and 2020. And then, of course, as I've noted, has some interplay with how much losses you may be generating eligible for carryback. So I'm not going to go into great detail on this other than saying that interest expense has always been a hot topic in terms of limitations on it, and that threshold has potentially been increased for taxpayers up to 50%. The year that comes into effect depends on how you're formed as a business, whether you're a partnership or a non-partnership, but certainly expecting increased thresholds for interest expense deductibility, which again could create more net operating losses, and we go back into the cyclical pattern. Excuse me. Marshall, you want to flip it for me one more time? Briefly touch on this. Section 139 was not actually established with the CARES Act, but has found some newfound prominence as a result of the economic circumstances we're facing. It allows employers to make payments to individuals to benefit them by reimbursement or paying any reasonable personal family living expenses, such as groceries, for example, and that payment's not going to be viewed as taxable to the employee, and it's fully deductible to you as the employer. Since it's not taxable, it's not reportable on a W-2 or 1099, but certainly a benefit that some companies that have the cash and are wanting to help their employees are taking advantage of. And then last slide, Marshall, just a little bit of housekeeping. Since normally we're looking next week at April 15th, which is the historical tax filing and payment deadline for individuals and corporations. The federal government has offered a deferral through July 15th for both filings and payments that would have otherwise been due, which would include first quarter payments for 2020. Interestingly enough, if the second quarter 2020 payments are still due June 15th, so we'll see if maybe we get a resolution between the conflict between first quarter coming after the due date for second quarter, but right now not looking at any payments due before June 15th. And interestingly, North Carolina, like many states, has also offered a shift on the due dates for income tax returns as well as some other tax filings in the state. But what North Carolina has not been able to offer, whereas some other states have, is that they are still going to assess you interest on the deferred payment from April 15th through July 15th. So something to be mindful of is that even if you don't have a payment that is necessarily due for North Carolina, they are going to run the clock and charge you interest on that deferral. So not all states are doing that. North Carolina is one of the few, but just want to be abundantly clear that that should probably factor into your decision as to whether or not to go ahead and remit a North Carolina payment if something would otherwise be due. Provided a link in our slide deck to the North Carolina Department of Revenue website. It's got a wealth of information, as well as discusses some of the non-income tax considerations and how the state is responding to those filing burdens as well. And then I think that's all I really had. I know that was very fast, but wanted to at least give us a couple minutes for questions here, hopefully.
Yeah, and thanks, Rebecca and JJ, and Jackie and Kevin are gonna come back on stage. But real quick, I've been monitoring the questions, and I see a couple that I'm just gonna pick off real quick. First thing, there was a question that's interesting because we've seen some of this in the news. The question was, what's your advice for Wells Fargo customers who can no longer apply through Wells Fargo? That's an interesting question. The reason behind that is, Wells Fargo has a statutory limit on how much they can grow their balance sheet right now, and so they're generally not being able to take much in the way of PPP applications. My general advice would be, there are definitely here in Raleigh, there are a lot of smaller lending banks and lending institutions that are SBA certified that can, that to my knowledge, are working and accepting new customers through the PPP program. If you're having a hard time identifying one, feel free to reach out to the chamber, reach out to me. We can provide references for you. I've spoken with lots of bankers who are able to take on additional requests at this point. So there was a question about how does the PPP apply for 1099 employees? Generally speaking, JJ and Rebecca, correct me, but 1099s are all but carved out of the PPP. And I think the logic behind that was that the 1099 independent contractors have their own unemployment provisions now, as were discussed under the CARES Act. So the 1099s are all but carved out. Is that, am I saying that right, JJ and Rebecca?
They also have the ability to apply for the PPP from their own perspective. So
For themselves, yes.
Yeah.
They'll have
There's
access
one
to
more.
it. They do it personally.
Right. And yeah, and actually that was one of the things that actually the application date for independent contractors and self-employed individuals is actually tomorrow. It opened for businesses on April 3rd, April 10th. Independent contractors and self-employed individuals can apply for the PPP. Last thing on that note, I saw a question: can a small business apply for more than one bank for a PPP? I'm not aware of anything that would prohibit you from applying at multiple banks. You would not be able to accept more than one loan, though. You have to certify when you're applying that you have not and you will not accept other PPP loans. So I don't think there's any issue necessarily with applying in multiple places. You would not be able to accept loans in multiple places. That's my thinking there. Kevin, you may have other thoughts on that, though.
I read that the same way you do. I don't have anything else on that.
Got it. Yeah, Jackie, I'll let you facilitate the rest.
Thank you, Marshall. I appreciate that. And thank you to Kevin, Marshall, JJ, and Rebecca for their insight and their resources today. Kevin, this question is for you. If your company is too small and not covered under FMLA, but is covered under EFMLA, does that mean you have to offer 12 weeks or 2 weeks?
Okay, so if you have fewer than 50 employees and you're not covered under traditional FMLA, that does not necessarily mean that you would not have to offer the 12 weeks of the emergency FMLA under the Families First Act. So the way Families First is written, you would potentially have to do that, but if you're under 50, you may be excluded based on the economic hardship analysis. So you just have to look at whether or not you could afford to let somebody take, and by afford meaning go by their guidance, afford to let somebody take that much time.
Kevin, this question is also for you. So employees who were laid off due to COVID-19 but started working for us after October are being denied benefits since they don't have enough income history. What can the employer tell them to do while they wait for federal benefits?
So I'm not sure I'm not going to have a good answer. I'm certainly not going to have a useful or helpful answer, I don't think, to this. The reality is the state unemployment systems are completely overloaded. If you leaving aside North Carolina for a second, I don't know if that's sort of a side note about, but I think it's illustrative of what's going on in the world. You know, the governor of New Jersey has asked if anyone who lives in New Jersey knows how to program in COBOL because their computer system is so archaic that no one knows how to fix it for the unemployment system. So I think that's indicative of, you know, how overrun these places are. I think there's a two-stage problem. One, even if the employer could do something, I'm not sure you can get anyone to talk to you at the Division of Employment Security right now. And two, the only thing the employer can do is provide accurate info to DES. So when the request for information comes in, they should be truthful and provide that. The other tool an employer has available is something called an attached claim, which is where the employer actually files for unemployment on behalf of its employees. I'm not sure that solves the problem, though, when the system is totally overloaded. So you know, I wish I had a better answer other than they appear to be trying very hard to work through the backlog. I saw today that Beth Wood, who's the state auditor, offered in short order all 350 of her staff members to go work for the unemployment folks. I think the reality is we're just scrambling around. There are going to be backlogs, and I don't have some silver bullet for employers to make use of. I understand the question. I just don't really have a solution for it.
Yeah, thank you. Marshall, this one is for you. Do tax deadline changes apply to payroll taxes as well?
So the there hasn't been any change to payroll tax deadlines, but now that most can defer, and I don't remember if we talked about this, but if you are expecting to get a PPP loan that you are expecting to then qualify for forgiveness for, there's not a lot of clarity on whether or not you can defer payroll taxes. So we're recommending that unless it is going to be something that truly could potentially put you out of business, that you do still make those payments on time. But with the payroll tax deferral, payroll taxes are not due for most businesses until 50% up in 2021 and 50% December of 2022. So the deadline doesn't technically change, other than you are able to opt to defer payment. That answers your question.
This question can be for anyone. So if a business closes down due to the executive order from the governor, are we required to provide the emergency sick leave through the new government program, or does the employee need to actually be sick, caring for someone as a reason they're leaving work?
So
Kevin,
I'll take that. Yeah, I'll take a shot at it. If I understand the question correctly, the DOL guidance on the Families First Act leave specifically says that if your work site is closed down, you're not entitled to the leave.
Yeah, so I think the confusion comes from the first option, which is talking about the government order, local, state, or national order. The confusing piece of that is related to the employee. So people think about employers that are closed down and think that under number one qualifies them to pay for sick pay, but it's talking about the employee being subject to that and that being a reason to not come to work. So for example, in North Carolina, if you had different areas where maybe the work site was still open, but maybe the person was under a shelter in place order and couldn't come to work, then that they could potentially qualify under the first provision of the sick pay. But when the work site is closed, as Kevin said, it specifically is related to employer versus employee. So all of the 6 provisions of the Families First is related to the employee, not the employer.
Thank you. Elliot Davis, this is a question for you. Can a 501c6 organization apply for financial assistance?
Is that in terms of PPP, Marshall? That might be for you.
Mm-hmm.
Yeah, I mean, my understanding is yes, there's no limitations that most nonprofits would be eligible to qualify. I think it'd be interesting if you want to reach out, you can reach out to us directly, and we could look at your individual circumstances and just look at it and make sure. But generally speaking, I believe so.
Mm-hmm. So generally speaking, yes, the PPP specifically does exclude the 501c6, but the rest of the provisions should apply as normal.
Okay, Marshall, you asked or you answered a lot of the questions already. A lot of questions. Go ahead, Marshall.
There was one on there that's interesting, and it's a good question. This is there guidance on how FTEs are calculated for businesses that have both full-time and part-time? And I think I know why the question's being asked, because there's a little bit of lack of clarity about how, when we talk about we have to stay at full employment to maintain PPP forgiveness. Some of the questioning that there's a position that relates to FTEs as opposed to headcount, or perhaps it's just full-time employees. Because if you read the SBA's PPP information sheet, it speaks to full-time employees, whereas there's other guidance that has been circulated that references FTEs. The answer to that question is we don't have clarity on it yet, and I think it just speaks to the fact that a lot of this guidance has been evolving quickly. We've seen FAQs 2 or 3 times already this week. We're expecting to have guidance from Treasury in the next week or so that really clarifies the forgiveness element of the PPP. I think we've gotten to the point where folks can apply and the application's out there, and we're obviously seeing a lot of applications in process. We're going to start wrestling with exactly what does forgiveness mean here in the next couple of weeks. That's a good question, Sophia. I think stay tuned. I think we're going to see some guidance on how is it full-time employees, FTEs, total headcount, how is that being captured in anticipation of forgiveness.
Kevin, this question is for you. So how are the number of days determined? Is it 20 work days per month or 30?
So, okay, I'm trying to, is there some reference in the question to determine for what purpose?
Let me see if I can find it. While I'm looking for that one, could you answer this one? Are there any options for loss of business coverage?
Yeah, so probably not. You know, this would normally be out of my area, except for I live with someone who owns an insurance agency. So talk about this on our walk every evening while we walk the dog. Particularly restaurants, and you know, if you followed it all, either restaurant news locally or nationally, I think Thomas Keller has actually filed a lawsuit over his business continuation coverage. But at least in North Carolina, every business interruption insurance policy is going to specifically exclude, not include these types of losses. So, for instance, a restaurant that had to shutter, the business interruption insurance is designed for things like the restaurant burned to the ground or something thereabouts. So those types of policies are in almost all cases not going to provide coverage for losses because of slowdowns or complete shutdowns. You know, unless you specifically paid for separate coverage. There's a story yesterday. I think Wimbledon is going to collect somewhere north of $100 million because they started paying for pandemic-specific coverage after the SARS outbreak. But in general, no. There are some laws that have been proposed in at least 3 states to try and have state legislatures pass laws that would force insurance companies to cover pandemic-related losses, even those that are specifically excluded by the policies people bought. In the unlikely event, in my mind, that a legislature would say that an insurance company has to pay for something that it specifically said it wouldn't pay for, I think those things will be tied up in court so long that they're not going to provide any immediate benefit for anybody. So in general, no. I mean, if somebody made a claim that they contracted COVID and had medical expenses at your business, you should talk to your general liability carrier. There may be a defense provided, even if ultimately the damages weren't paid for. But if you're just talking about loss of revenue, almost certainly not in terms of coverage.
So for the PPP, do you have to hire back the same employees or just the same number of employees?
I think I see JJ nodding too, so I'll kick it to her. My interpretation of that is they're looking at headcount, not names. And so if you have somebody laid off that was making $50,000 a year and you replace that person and pay the new person $50,000 a year, that you're clean under your obligations.
Yeah, agreed. Marshall, any thoughts there?
Yeah, I think that's another one of those things that we're waiting on crystal clarity on. I agree with what was just said. It doesn't. I've not read anything that says that it's specifically attributable to individual employees as much as it is headcount. It raises I've had a question in my mind really since the outset when we talk about the payroll reductions, though. How do we accomplish that if we're not, if we don't have comparability of positions and things like that? So at this point, I'm not aware of anything that would say that it has to be the same exact employee. It's just got to be the same headcount, full-time headcount. If you read the SBA's FAQs, it says full-time employee headcount.
Okay, and then Kevin, I just heard back. So the person asking about the number of days, they are asking for the 511 and the 200 per day. Does that make sense?
Yeah, so the 511, so the sick leave portion is limited, as we said, to 80 hours. So I think, the answer is if somebody's schedule is not the same as it has always been, there's a six-month look back is what's baked into the law. So for instance, if somebody's schedule is dramatically reduced right before April 1st, you don't get to count their work schedule as it has been changed. You count what it was over the previous 6 months. So if I'm understanding the question right, I mean, basically you look at what their schedule was. So if they typically worked 4 8-hour days or 4 10-hour days, then the leave that they would take would be 4 10-hour days, if that makes sense. And you would apply it accordingly.
Perfect. And then for Elliot Davis, is the CARE Act paycheck loan amounts that are forgiven considered taxable income?
I think the question is the PPP forgiveness, the paycheck protection loan. If that is forgiven, that is not taxable income. I think that, and I just saw one pop up that I think I can answer real quickly. I think the question was if you have multiple applications at multiple banks, I think that the spirit of the question is, will you get different terms at different banks, or is it going to be the same across all the banks? My understanding is that it'll be the same terms, same amounts, really all the same terms will be the same across banks. So it takes the competitiveness out of it. It's really just that they're trying to spread the load across naturally multiple institutions. So you should not have to price rate shop. The rates are fixed, the terms are fixed, things like that.
Marshall, going back to your comment about the forgiveness not being taxable, that's definitely true for federal tax purposes. It's not beyond the realm of possibility that some states are going to view that as taxable. So, obviously state tax rates are far lower than federal tax rates, so it may be a non-issue, but it would be premature to say across the board that all states are also going to treat it similarly. We have yet to see how the states will necessarily conform to all the CARES Act provisions.
Yep.
Well, I want to thank you all for being on this webinar with us this afternoon and for your valuable information. So again, thank you to Marshall, JJ, Rachel, and Kevin for being with us today. We will share the PowerPoint presentations of both Elliot Davis and Kevin's PowerPoint presentation. We also recorded this webinar and we will be able to share it with everyone next week. So please be on the lookout for that. And we also at the Raleigh Chamber have created a response website for COVID-19, and that website is response.raleighchamber.org. It is updated very often, almost every single day, and there is an opportunity for you to continue to submit your questions onto the website. So feel free to go to response.raleighchamber.org and we will get your questions to the Elliot Davis team and to Kevin. So thank you all again for being with us this afternoon. I hope everyone has a wonderful weekend and everyone be well and stay safe. Thanks all.
Thank you.
Bye.
Bye.